If you enjoyed this audiobook, please consider liking, sharing, and subscribing to the channel. Sharing it with your friends and family helps spread knowledge, and when we help others grow, we grow too. Thank you so much for listening. Let's dive into the audiobook. Chapter 1, The Tax Puzzle Unlocked. Part 1, Getting to Know Your Taxes. What hits your wallet? When Warren Buffett famously said he pays a lower tax rate than his secretary, he sparked a global conversation about tax systems. Yet this revelation also highlighted a crucial truth. Understanding how taxes actually work can transform your financial future in ways most people never imagine. Think of your paycheck as a river flowing toward multiple destinations. Before it reaches your bank account, various tributaries divert portions along predetermined channels. Income tax represents the largest stream, but property taxes, sales taxes, and professional taxes create additional currents that steadily drain your financial reservoir. Consider Sarah, a software engineer earning $75,000 annually. Her employer withholds approximately $12,000 for federal income tax, $4,650 for Social Security and Medicare, and another $3,500 for state taxes. Meanwhile, her $300,000 home generates $3,600 in annual property taxes, while daily purchases add roughly $2,500 in sales taxes. Without realizing it, Sarah surrenders nearly 35% of her gross income to various tax authorities. The complexity extends beyond simple percentages. Different income sources face distinct tax treatments. Sarah's salary endures immediate withholding, but her freelance consulting income escapes upfront taxation until quarterly estimated payments come due. Her rental property income for a small apartment faces different rules entirely, allowing depreciation deductions that can actually create paper losses while generating positive cash flow. Property taxes operate independently from income levels, creating situations where retirees on fixed incomes face rising bills as property values increase. Sales taxes disproportionately impact lower-income households who spend larger percentages of their earnings on taxable goods rather than saving or investing. Most taxpayers view this system as an immutable force of nature, like gravity or weather patterns. However, tax codes contain hundreds of provisions specifically designed to reward certain behaviors and investments. These aren't loopholes in the traditional sense, but rather intentional policy tools that lawmakers use to encourage economic activities they deem beneficial. The mortgage interest deduction exists to promote homeownership. Retirement account contributions receive tax advantages to encourage personal savings. Business expense deductions support entrepreneurship and economic growth. Educational credits make learning more accessible. Each provision represents a conscious decision by policymakers to reduce tax burdens for taxpayers who engage in specific activities. Understanding this framework shifts your perspective from passive victim to active participant. Instead of accepting whatever taxes happen naturally, you can structure your financial decisions to align with these policy objectives. The accountant who helps small business owners often pays less in taxes than the employee earning twice as much, not through illegal schemes, but by organizing their financial life around legitimate tax incentives. This approach requires viewing taxes as a strategic element of financial planning, rather than an unavoidable expense. When you understand which streams flow where and why, you can redirect some of those tributaries back toward your financial goals while maintaining complete legal compliance. Part 2. The Art of Legal Loopholes. Finding Your Tax-Saving Paths. When Warren Buffett paid a lower tax rate than his secretary in 2012, he wasn't breaking any laws. He was simply better at working within the system. The difference between tax avoidance and tax evasion lies in this single principle. One uses the law as written, while the other violates it entirely. Legal tax planning operates on a fundamental truth that most taxpayers miss. Tax codes aren't just collections of penalties. They're roadmaps filled with intentional incentives. When lawmakers want to encourage home ownership, they create mortgage interest deductions. When they want to boost retirement savings, they offer 401k advantages. These aren't accidents or oversights. They're deliberate policy tools designed to guide economic behavior. Consider how Amazon legally paid zero federal taxes in 2018, despite billions in profits. They leveraged legitimate provisions like research and development credits, accelerated depreciation, and stock-based compensation deductions. While controversial, these strategies operate entirely within legal boundaries because they align with congressional intent to reward innovation and business investment. The key distinction emerges in approach and transparency. Legal tax optimization requires full disclosure and operates through established channels. When real estate mogul Sam Zell structures property deals through opportunity zones, he documents everything meticulously and reports all transactions. His tax savings come from utilizing provisions specifically created to encourage investment in economically distressed areas. Courts consistently uphold this principle through the business purpose doctrine. In Gregory v. Sam Helvering, the Supreme Court established that transactions must have genuine business purposes beyond tax avoidance. This means you can't create artificial losses or shell companies solely to reduce taxes, but you can absolutely structure legitimate business decisions to optimize tax outcomes. Smart taxpayers stay informed about evolving regulations because tax law changes create new opportunities. When the Tax Cuts and Jobs Act introduced the qualified business income deduction in 2017, savvy small business owners restructured their operations to capture this 20% deduction. They didn't bend rules, they adapted to new ones. The most overlooked aspect involves timing and documentation. Legal tax planning requires meticulous record-keeping and strategic timing of transactions. When tech entrepreneur Elon Musk exercises stock options or sells shares, his team coordinates these transactions with tax loss harvesting and charitable giving to minimize overall impact. Professional guidance becomes essential because tax professionals understand which provisions apply to your specific situation. They know that Section 199A benefits service businesses differently than manufacturing companies, or that certain retirement contributions can still be made after year-end under specific circumstances. The foundation of successful tax planning rests on understanding that these provisions exist by design, not by accident. Your job isn't to find loopholes that lawmakers missed, but to identify legitimate incentives they intentionally created for taxpayers in your situation. Part 3. Deductions Demystified, your secret weapon for savings. Most taxpayers leave thousands of dollars on the table each year simply because they treat deductions like optional paperwork rather than powerful financial tools. Research by the National Taxpayer Advocate reveals that over 40% of eligible taxpayers miss significant deductions annually, effectively overpaying their taxes by an average of $1,200. Deductions reduce your taxable income dollar for dollar, making them your most direct path to tax savings. When Sarah, a marketing consultant from Denver, started tracking her home office expenses, business meals, and professional development costs, she discovered $8,400 in legitimate deductions she'd previously ignored. Her tax bill dropped from $12,000 to $9,800 that year. The key lies in understanding that deductions fall into distinct categories, each with specific rules and opportunities. Business expenses represent the largest category for self-employed individuals and entrepreneurs. Office supplies, professional software, industry conferences, and even that laptop you use for client presentations become deductible expenses when properly documented. Home office deductions often intimidate taxpayers, but the simplified method makes this straightforward. If you use 200 square feet of your 2,000 square foot home exclusively for business, you can deduct 10% of eligible home expenses, including utilities, repairs, and mortgage interest. Tech entrepreneur Mark Cuban famously maximized home office deductions during his early business years, converting personal expenses into legitimate business deductions. Education expenses create another significant opportunity. The American Opportunity Tax Credit allows up to $2,500 in credits for qualified education expenses, while the Lifetime Learning Credit covers 20% of the first $10,000 in tuition costs. Professional development courses, industry certifications, and even books related to your field become deductible when they maintain or improve skills required in your current job. Investment-related deductions include advisory fees, safe deposit box rentals, and investment publications. While investment interest deduction rules changed under recent tax reforms, you can still deduct investment interest up to your net investment income. Real estate investor Barbara Corcoran built wealth partly by maximizing depreciation deductions on rental properties, turning paper losses into real tax savings. Medical expenses exceeding 7.5% of your adjusted gross income become deductible, including insurance premiums, prescription costs, and travel expenses for medical care. Many taxpayers overlook dental work, vision care, and medical equipment as qualifying expenses. The secret to maximizing deductions involves meticulous record-keeping throughout the year, not just during tax season. Create separate folders for different deduction categories and photograph receipts immediately. Consider using apps like Expensify or QuickBooks Self-Employed to track expenses in real time. How many legitimate deductions are you currently missing? Start by auditing last year's expenses against IRS guidelines. The difference between taxpayers who minimize their liability and those who overpay often comes down to recognizing that every business lunch, professional book, or work-related expense represents potential savings when properly documented and claimed. Part 4. Exemptions and Rebates, Little Helpers in Your Tax Journey. When Netflix saved $15 million in 2019 by restructuring employee stock options as exemptions rather than taxable compensation, they demonstrated how understanding the difference between exemptions and rebates can transform financial outcomes. Most taxpayers confuse these two powerful tools, missing opportunities that could save thousands annually. Exemptions work like invisible shields, protecting certain income from taxation altogether. Think of them as portions of your earnings that the tax code declares off-limits to government collection. Unlike deductions that reduce your taxable income, exemptions remove specific income streams from the tax calculation entirely. Agriculture income in India, for example, remains completely exempt regardless of amount. A farmer earning 10 lakh rupees from crop sales pays zero tax on that income, while a software engineer earning the same amount faces substantial liability. The key distinction becomes clearer when examining allowances. House rent allowance, HRA, can become partially or fully exempt based on specific conditions. If you pay 25,000 rupees monthly rent in Mumbai and receive 30,000 rupees HRA, the entire 25,000 rupees becomes exempt from taxation when properly claimed. This isn't a deduction reducing taxable income by that amount. It's complete exemption, meaning that money never enters tax calculations. Rebates operate differently, functioning as direct discounts on your final tax liability. While exemptions prevent income from being taxed, rebates reduce the actual tax you owe after calculations are complete. Section 87A provides a perfect illustration. Taxpayers earning up to 5 lakh rupees receive a complete rebate of 12,500 rupees, effectively making their tax liability zero. This isn't about reducing taxable income. It's a straight discount on the tax bill itself. Investment-based rebates under Section 80C demonstrate practical application. When Priya invests 1.5 lakh rupees in ELSS mutual funds, she doesn't just reduce her taxable income by that amount. She becomes eligible for rebates that directly cut her tax liability, creating a double benefit of wealth building and immediate tax savings. The timing of claiming exemptions versus rebates requires strategic thinking. Exemptions must be structured during income generation. You cannot retroactively make salary components exempt. Rebates, however, can often be optimized during filing through eligible investments or qualifying expenditures made throughout the year. Consider the case of freelance graphic designer Rajesh, who earns 8 lakh rupees annually. By restructuring client payments to include exempt allowances where legally permissible and investing in rebate-eligible schemes, he reduced his effective tax rate from 20% to 8%. The combination of exemptions removing 2 lakh rupees from taxation and rebates cutting his final liability by 15,000 rupees created substantial savings. Understanding these mechanisms requires moving beyond surface-level tax planning. Exemptions demand proactive income structuring, while rebates reward strategic investment timing. Smart taxpayers use exemptions to reduce the base subject to taxation, then apply rebates to minimize what remains payable. This dual approach transforms tax planning from reactive filing to proactive wealth preservation, ensuring every legal avenue for reducing tax burden gets maximized effectively. Chapter 2. Smart Moves for Salaries and Savings. Part 1. Salary Structure Secrets. More than just paychecks. When Infosys restructured employee compensation packages in 2019, something remarkable happened. Despite offering the same gross salary amounts, employees suddenly found themselves taking home significantly more money each month. The secret wasn't magic or creative accounting. It was intelligent salary structuring that transformed how compensation components interacted with tax regulations. Your salary slip contains far more than just your basic pay. Each component carries different tax implications, and understanding these distinctions can dramatically impact your annual tax liability. Think of your salary structure like a recipe, where the same ingredients mixed in different proportions create entirely different flavors and tax outcomes. Basic salary forms the foundation, but it's fully taxable and attracts the highest tax rates. House rent allowance, HRA, however, operates under different rules entirely. If you live in a rented property, HRA provides substantial tax relief. The exemption equals the lowest of 3 calculations. Actual HRA received, 50% of basic salary for metro cities, 40% for others, or actual rent minus 10% of basic salary. For someone earning 50,000 rupees monthly basic salary in Mumbai, receiving 25,000 rupees HRA and paying 20,000 rent, the entire HRA becomes tax-free. Conveyance allowance offers another opportunity. Up to 1,600 rupees monthly remains completely exempt from taxation, regardless of actual transport expenses. Medical reimbursements up to 15,000 rupees annually avoid taxation when supported by proper bills and prescriptions. The Leave Travel Allowance, LTA, creates interesting possibilities. While it covers domestic travel expenses for family vacations, the tax benefit applies only to transportation costs, not accommodation or meals. Smart employees time their family trips to maximize this benefit during high-earning years. Company-provided perquisites require careful evaluation. A company car used for personal purposes attracts perquisite tax, but if used solely for business, it remains tax-free. Similarly, mobile phone bills paid by employers stay exempt if justified for business use. Consider negotiating your salary structure rather than simply accepting what's offered. A software engineer earning 12 lakh rupees annually might benefit more from 6 lakh rupees basic salary, 3 lakh rupees HRA, 1.2 lakh special allowance, and 1.8 lakh performance bonuses compared to 10 lakh rupees basic salary with minimal allowances. Bonus structures matter significantly. Performance bonuses exceeding 20% of salary face different tax treatment than those within this limit. Annual bonuses often push individuals into higher tax brackets, while spreading similar amounts across monthly special allowances might result in lower overall taxation. Documentation becomes crucial for claiming these benefits legitimately. HRA requires rent receipts and rental agreements. Medical reimbursements need genuine medical bills. LTA demands travel tickets and hotel bills for transportation portions. The key lies in optimizing rather than maximizing individual components. A well-structured salary considers your actual expenses, lifestyle, and tax-saving goals to create the most efficient overall package. Part 2. Investments that pay you back. Tax benefits made simple. When Microsoft's early employees received stock options in the 1980s, many dismissed them as worthless paper. Those who invested in the company's employee stock purchase plan while claiming tax deductions watched their modest contributions transform into millions. This demonstrates a powerful truth about tax-saving investments. The best ones serve double duty, reducing your current tax burden while building genuine wealth. Tax-saving investments differ fundamentally from regular savings accounts or fixed deposits. While traditional savings earn interest that gets taxed, Section 80C investments offer immediate tax deductions up to 1.5 lakh rupee annually. Consider Ravi, a software engineer earning 12 lakh rupee annually. By investing 1.5 lakh rupee in tax-saving instruments, he reduces his taxable income to 10.5 lakh rupee, saving approximately 46,800 rupee in taxes if he falls in the 30% bracket. The Public Provident Fund stands out as India's most popular tax-saving investment. With a 15-year lock-in period and current returns around 7.1%, PPF offers triple tax benefits. Your contributions qualify for Section 80C deductions. The interest earned remains tax-free, and the final maturity amount faces no taxation. Suresh Krishnamurthy, a Chennai-based chartered accountant, consistently invested 1.5 lakh rupee annually in PPF for 15 years. His total investment of 22.5 lakh matured to over 40 lakh rupee, completely tax-free. Equity-linked savings schemes provide market-linked returns with tax benefits. These mutual funds invest primarily in stocks and come with a 3-year lock-in period. During the 2009 to 2014 bull run, many ELSS investors saw annual returns exceeding 20%. However, they also experienced volatility during market downturns. The key lies in systematic investment plans, spreading risk across market cycles while claiming annual tax deductions. Life insurance serves dual purposes when chosen correctly. Term insurance offers maximum coverage at minimum cost, while certain life insurance policies qualify for Section 80C benefits. However, traditional life insurance often provides poor investment returns compared to dedicated investment products. Financial advisors typically recommend buying term insurance separately and investing the difference in higher-yielding tax-saving instruments. National savings certificates offer government-backed security with competitive returns, currently yielding around 6.8% annually. NSC investments qualify for Section 80C deductions. The 5-year maturity period suits conservative investors seeking predictable returns without market volatility. Smart investors create tax-efficient portfolios by diversifying across multiple instruments. They might allocate 50,000 rupee to PPF for long-term security, 75,000 rupee to ELSS for growth potential, and 25,000 rupee to NSC for stability. This approach maximizes the 1.5 lakh Section 80C limit while balancing risk and return. The compounding effect becomes remarkable over time. A 25-year-old investing 12,500 rupee monthly in tax-saving instruments could accumulate over 2 crore by retirement, while saving substantial taxes annually. This demonstrates why successful wealth builders treat tax-saving investments not as burdens, but as opportunities to build financial freedom systematically. Part 3. Retirement Savings, Planning Today for a Stress-Free Tomorrow. When Akash Mehta received his first salary slip at 25, he barely glanced at the retirement savings deduction. 25 years later, watching his EPF balance cross 1.2 crore, he realized that overlooking retirement planning isn't just about missing future security. It's about throwing away thousands in tax savings today. Most working professionals treat retirement savings as a distant concern. Yet these contributions represent some of the most powerful tax-saving tools available. The magic lies in their triple benefit structure: immediate tax deductions, tax-free growth over decades, and favorable withdrawal treatment. Consider this your financial time machine, where every rupee saved today works harder than any other investment while reducing your current tax burden. The Employees' Provident Fund remains the foundation of retirement planning for salaried individuals. Your mandatory 12% contribution, matched by your employer, creates a substantial corpus while reducing taxable income. But here's what most people miss. Voluntary contributions to the Voluntary Provident Fund can push your total EPF investment beyond the mandatory amount, maximizing both tax savings and retirement security. A software engineer contributing an additional 50,000 rupees annually to VPF not only saves 15,000 rupees in taxes, but builds an extra 25 lakh rupees retirement corpus over 30 years. The National Pension Scheme offers even more flexibility for tax optimization. Under Section 80 CCD 1B, you can claim an additional 50,000 rupees deduction beyond the 1.5 lakh rupee limit under Section 80C. This unique benefit means NPS contributions don't compete with your other tax-saving investments, they supplement them. A marketing manager investing 2 lakh rupees annually, 1.5 lakh under 80C, plus 50,000 rupees under 80 CCD 1B, saves 62,000 rupees in taxes while building a diversified retirement portfolio managed by professional fund managers. Annuity plans deserve special attention for their guaranteed income potential. While returns may seem modest compared to market investments, their tax-free periodic payouts during retirement create predictable cash flow. The key lies in timing. Purchasing annuities during high-income years maximizes immediate tax benefits while securing future income streams. Corporate pension schemes often provide the most overlooked opportunities. Many employees fail to optimize their contribution levels, missing substantial tax benefits. A senior manager increasing pension contributions from 10% to 15% of salary not only reduces current taxes, but creates employer-matched growth that compounds tax-free for decades. The withdrawal strategy matters as much as contributions. EPF withdrawals after 5 years of service remain completely tax-free, while NPS offers partial tax-free withdrawal options. This creates opportunities for tax-efficient retirement income planning that most financial advisors barely discuss. Smart retirement planning transforms from a future obligation into an immediate tax strategy. Every rupee contributed today reduces your tax liability while securing tomorrow's financial independence. The question isn't whether you can afford to save for retirement, it's whether you can afford not to maximize these powerful tax benefits while building your financial future. Part 4. Perks and Allowances. Make every penny count. Business leaders have discovered a goldmine hiding in plain sight within their own salary structures. A senior marketing executive at Tata Consultancy Services reduced his taxable income by rupees 1.8 lakh annually simply by restructuring his existing compensation through legitimate perks and allowances, without his employer spending an additional rupee. The transformation becomes clear when you examine the numbers. Consider medical reimbursements, which remain completely tax-free up to 15,000 per year. Infosys employees routinely submit bills for routine health checkups, prescription glasses, and dental treatments. Each rupee claimed reduces taxable income directly. Yet surveys reveal that over 60% of salaried professionals never utilize this basic benefit. Food coupons present another immediate opportunity. Companies like ABCL Technologies provide meal vouchers worth 2,200 monthly, totaling 26,400 annually in tax-free benefits. These digital vouchers work seamlessly across thousands of restaurants and grocery stores. The employee receives the full value while the employer claims it as a business expense. Travel allowances create substantial savings when documented properly. A regional sales manager at Mahindra & Mahindra claims 19,200 annually for local travel expenses. The key lies in maintaining detailed records, fuel receipts, toll payments, and cab bills. Each documented journey becomes a legitimate tax reduction. Corporate mobile phone reimbursements offer another avenue. Wipro reimburses employees up to $20,000 annually for business phone usage. The catch? The connection must be in the company's name, and personal usage should remain minimal. This benefit alone can save rupees $6,000 in taxes for someone in the 30% bracket. Leave travel allowance deserves special attention. Air India employees regularly claim rupees 1 lakh or more for domestic family vacations. The allowance covers actual travel costs for the employee, spouse, and up to 2 children. Hotels and local transport don't qualify, but flight tickets and train fares receive full exemption. Club membership reimbursements present opportunities for senior professionals. Ernst & Young partners receive tax-free reimbursements for business club memberships used for client entertainment. The annual value can reach rupees $50,000, creating significant tax savings. Documentation becomes crucial for every claim. The Income Tax Department scrutinizes reimbursements during assessments. Successful professionals maintain digital folders with receipts, bills, and supporting documents organized by category. This preparation prevents costly disputes later. Professional development allowances deserve consideration too. Companies like Deloitte reimburse employees for certification courses and training programs. These investments in skills remain completely tax-free while enhancing career prospects. The cumulative impact surprises most people. A software architect earning rupees 15 lakh annually reduced her tax liability by rupees $45,000 through systematic use of available perks. She restructured her salary package to include maximum allowable reimbursements, rather than accepting everything as basic pay. This strategic approach transformed her effective tax rate while maintaining the same gross compensation. Chapter 3: Business and Property, The Bigger Game. Part 1: Turning Business Expenses into Tax Allies. When Netflix transformed from DVD rentals to streaming giant, they didn't just change their business model, they revolutionized their approach to business expenses. Every software license, every data center cost, and every employee training session became a strategic tax deduction that helped fuel their massive expansion while reducing their tax burden by millions annually. Think of business expenses as financial soldiers fighting on your behalf against the tax collector. Every legitimate business cost you incur becomes ammunition to reduce your taxable income. The IRS and tax authorities worldwide operate on a simple principle. You should only pay taxes on your actual profit, not on money you've already spent to generate that profit. The magic happens when you shift your perspective from viewing expenses as money going out to seeing them as tax reduction opportunities coming in. Take Sarah, a freelance graphic designer who initially worked from coffee shops. When she calculated that her annual coffee shop expenses exceeded $3,000, she realized she could rent a proper office space for $2,400 annually and deduct the entire amount, effectively getting professional workspace while reducing her taxes. Office rent represents one of the most straightforward deductions. Whether you lease commercial space or claim a home office deduction, these costs directly reduce your taxable income dollar for dollar. The home office deduction alone saved American taxpayers over $3.4 billion in 2023, according to IRS data. Travel expenses offer another goldmine of opportunities. When Uber's early employees traveled to establish operations in new cities, every flight, hotel stay, and meal became a deductible business expense. The key lies in maintaining clear business purposes than detailed records. A $500 business trip doesn't just cost you $500. It potentially saves you $100 to $150 in taxes, depending on your bracket. Equipment and technology purchases create immediate deductions through depreciation or Section 179 deductions in the U.S., allowing businesses to deduct up to $1.16 million in equipment purchases annually. That new laptop, software subscription, or machinery doesn't just serve your business, it serves your tax strategy. Professional services like legal fees, accounting costs, and consulting expenses all qualify as deductions. Even this tax planning advice becomes a deductible business expense, creating a virtuous cycle where investing in professional guidance pays for itself through tax savings. The secret sauce lies in meticulous record-keeping. Amazon's founder Jeff Bezos famously maintained detailed expense records during the company's early years, treating every business meal and office supply purchase as both a business necessity and tax opportunity. Digital tools now make this process seamless, automatically categorizing expenses and calculating potential tax savings in real time. Understanding which expenses qualify requires knowing the ordinary and necessary test. Expenses must be common in your industry and helpful for your business. A restaurant owner can deduct food costs. A consultant cannot deduct personal groceries even if eaten while working. Your business expenses aren't just costs. They're your most powerful allies in legal tax reduction, transforming necessary spending into strategic tax planning victories. Part 2. Real estate and taxes, unlocking hidden benefits. When John bought his first rental property in 2019, he paid $4,200 in property taxes and considered it just another cost of ownership. 3 years later, after learning proper record keeping, those same property taxes became part of a $12,000 annual deduction package that reduced his taxable income substantially. His transformation from passive homeowner to strategic real estate tax planner illustrates how property ownership offers some of the most powerful tax advantages available to individual investors. Real estate taxation operates on multiple levels, each presenting distinct opportunities for legitimate tax reduction. Your primary residence serves as more than shelter. It functions as a tax-advantaged investment vehicle. Under current regulations, homeowners can deduct mortgage interest on loans up to $750,000, property taxes up to $10,000 annually, and certain home improvement costs that increase property value. When selling, the capital gains exclusion allows married couples to exclude up to $500,000 in profit from taxation, provided they lived in the home for 2 of the past 5 years. Consider Sarah Chen, a software engineer who purchased her San Francisco home in 2018 for $800,000. When she sold it in 2023 for $1.3 million, the $500,000 gain fell entirely within her married filing jointly exclusion. She paid zero capital gains tax on a $500,000 profit, demonstrating how residential real estate can generate completely tax-free wealth accumulation. Rental properties offer even more extensive tax benefits through depreciation, expense deductions, and strategic structuring. The IRS allows property owners to depreciate residential rental buildings over 27.5 years, creating significant paper losses that offset rental income. A $275,000 rental property generates approximately $10,000 in annual depreciation deductions before considering actual expenses like repairs, maintenance, property management fees, and travel costs for property inspection. Real estate professional status provides additional advantages for active property investors. Maria Rodriguez, who manages 15 rental units in Austin, qualified for this status by spending over 750 hours annually on real estate activities and maintaining detailed logs. This designation allows her to deduct rental losses against her other income, rather than limiting them to $25,000 annually like passive investors. The 1031 exchange mechanism enables property investors to defer capital gains taxes indefinitely by reinvesting proceeds into similar properties. Commercial real estate investor David Kim has used this strategy 3 times since 2015, growing his portfolio from one $400,000 duplex to a $2.2 million apartment complex without paying capital gains taxes on intermediate sales. Each exchange preserved his capital for continued investment rather than tax payments. Property depreciation recapture requires careful planning when selling rental properties. While depreciation reduces taxable income during ownership, the IRS recaptures these deductions at sale, taxing them at up to 25% rather than capital gains rates. Smart investors plan exit strategies that minimize this impact through installment sales, charitable remainder trusts, or reinvestment strategies. Record keeping becomes critical for maximizing real estate tax benefits. Every property-related expense, from lawn care to major repairs, requires documentation. Digital tools now simplify this process, but the fundamental principle remains. Undocumented expenses cannot be deducted, regardless of legitimacy. Part 3. Keeping your books clean, the foundation of smart tax planning. When Microsoft faced an IRS audit in 2019, their meticulous bookkeeping saved them from $2.9 billion in additional assessments. The tech giant's organized financial records allowed them to defend their transfer pricing decisions and international tax strategies successfully. This real-world example demonstrates a fundamental truth. Clean books are not just about compliance. They are your strongest weapon in the tax efficiency battle. Think of your financial records as the foundation of a house. Without solid groundwork, everything built on top becomes unstable. Warren Buffett's Berkshire Hathaway maintains such detailed records that their annual reports become reference materials for other companies. This level of organization allows them to maximize every available deduction while staying bulletproof during audits. The digital revolution has transformed bookkeeping from a tedious chore into a strategic advantage. QuickBooks, Xero, and similar platforms automatically categorize expenses, track invoices, and generate reports that tax professionals dream about. Consider Sarah Chen, a freelance graphic designer who increased her tax deductions by 40% simply by switching from shoebox receipts to cloud-based tracking. Her organized system revealed legitimate business expenses she had previously overlooked. Documentation timing matters more than most realize. The IRS requires contemporaneous records for certain deductions, meaning you cannot recreate documentation after the fact. When Uber drivers started using apps like MileIQ to track business miles in real time, their average deductions increased by $3,200 annually compared to those relying on manual logs created months later. Monthly reconciliation prevents year-end disasters. Small business owner Marcus Rodriguez learned this lesson when his hastily assembled year-end records missed $18,000 in legitimate deductions. Now he dedicates 2 hours monthly to reviewing transactions, categorizing expenses, and updating his books. This simple habit transformed his tax preparation from a stressful scramble into a confident presentation of organized facts. The audit protection that clean books provide extends beyond immediate tax savings. When the IRS examined restaurant chain Chipotle's books, their systematic expense tracking and receipt retention allowed them to substantiate every claimed deduction. Companies with organized records resolve audits 60% faster and with significantly lower additional assessments than those with chaotic documentation. Modern bookkeeping integrates seamlessly with tax planning software. When your books connect directly to tax preparation programs, human error decreases dramatically while strategic opportunities become visible. Real estate investor Jennifer Walsh discovered she could restructure certain expenses between personal and business categories, legally reducing her tax burden by $12,000 annually. Clean books reveal patterns that informal tracking misses. Business owners often discover seasonal trends in their expenses, identifying optimal timing for major purchases or equipment upgrades to maximize tax benefits. This level of insight transforms bookkeeping from a reactive compliance task into a proactive tax strategy tool that compounds savings year after year. Part 4. Compliance without stress, staying on the right side of the law. When Microsoft faced an IRS audit in 2015 over its international transfer pricing arrangements, the company's meticulous record-keeping and proactive compliance approach ultimately saved millions in potential penalties. This illustrates a fundamental truth about tax planning. Compliance isn't the enemy of optimization. It's your strongest ally. Think of compliance as building a fortress around your tax savings. Every deduction you claim, every expense you categorize, every document you maintain becomes a defensive wall protecting your financial strategies. The moment you cut corners on compliance, you create vulnerabilities that can cost far more than any tax you might save. Filing deadlines aren't suggestions, they're non-negotiable boundaries. In 2023, the IRS collected over $1.2 billion in late filing penalties alone. Real estate developer Marcus Chen learned this lesson painfully when a missed quarterly payment deadline cost him $18,000 in penalties on a property deal that would have otherwise saved him substantial taxes. The irony? He had the money and simply forgot the date. Smart taxpayers treat compliance like preventive medicine. They maintain detailed records not because they expect audits, but because organized documentation transforms stressful inquiries into routine conversations. When small business owner Sarah Rodriguez received an audit notice, her detailed expense tracking and receipt management turned what could have been a months-long ordeal into a 3-week review that validated all her claimed deductions. Record retention follows a simple rule. When in doubt, keep it longer. The IRS typically has 3 years to audit most returns, but this extends to 6 years for substantial underreporting. Some records, like property basis documentation and depreciation schedules, need preservation for decades. Consider digital storage. Scanning receipts and maintaining cloud backups costs little, but provides enormous peace of mind. What happens when you receive that dreaded IRS notice? First, breathe. Most notices aren't audits. They're simple requests for clarification or additional documentation. Read carefully, respond promptly, and provide exactly what's requested. Nothing more, nothing less. Automotive parts distributor David Park received a notice questioning his home office deduction. His measured response with supporting documentation resolved the matter in 2 weeks without penalties. Professional help isn't admitting defeat, it's strategic insurance. Tax attorneys and CPAs understand audit procedures, speak the IRS language, and can often resolve issues before they escalate. The cost of professional representation during an audit typically runs a fraction of potential penalties and lost time. Remember that aggressive tax planning without robust compliance creates false savings. You haven't saved money if penalties and interest eventually consume your benefits. The most successful tax planners marry creative strategies with conservative compliance practices, creating sustainable savings that withstand scrutiny while building wealth over time. Chapter 4: Modern Tax Hacks and Planning Ahead, Part 1. Making the most of new tax rules. Keeping up with change. When the 2018 Tax Cuts and Jobs Act eliminated personal exemptions while doubling the standard deduction, millions of Americans discovered their tried-and-true tax strategies had become obsolete overnight. Those who adapted quickly saved thousands, while others paid unnecessary taxes simply because they failed to update their approach to match the new reality. Tax laws change constantly, and each modification creates both opportunities and pitfalls for taxpayers. The Indian Finance Act typically introduces dozens of amendments annually, while countries like the United States see significant overhauls every few years. Consider how the introduction of the new tax regime in India in 2020 fundamentally altered the calculation for many taxpayers. Those who immediately analyzed both old and new systems could choose the more beneficial option, while others missed substantial savings by defaulting to familiar territory. Staying current requires establishing reliable information channels. The Income Tax Department's official circulars and notifications provide authoritative guidance, but they often arrive in dense legal language. Professional tax publications like Taxman's Updates translate these changes into practical implications. Many successful tax planners subscribe to multiple sources, cross-referencing interpretations to ensure comprehensive understanding. Real estate investors learn this lesson dramatically when the 2017 changes to like-kind exchanges in the United States eliminated certain property swaps that had been profitable for decades. Those who monitored the proposed legislation early restructured their portfolios before the deadline, preserving tax advantages. Others discovered their strategies had become taxable events only after completing transactions. The key lies in proactive monitoring rather than reactive adjustment. Set calendar reminders for budget announcements and Finance Act publications. When changes appear, immediately assess their impact on your existing strategies. A simple spreadsheet comparing old versus new calculations often reveals whether modifications benefit your situation. Consider the introduction of Section 80 CCD 1B in India, which added an additional deduction for National Pension Scheme contributions. Taxpayers who quickly incorporated this provision into their investment planning gained an extra layer of tax savings. Those who waited years to adapt missed cumulative benefits worth lakhs of rupees. Technology amplifies the challenge of staying current. Digital transactions create more data points requiring analysis under evolving regulations. The introduction of TDS on e-commerce transactions, for example, demanded immediate attention from online sellers to avoid compliance issues. Professional consultation becomes invaluable during transition periods. When the goods and services tax replaced multiple indirect taxes in India, businesses that engaged experts early navigated the changeover smoothly. Those who attempted self-interpretation often faced penalties and missed optimization opportunities. Building adaptability into your tax strategy creates resilience against future changes. Diversify across multiple saving instruments rather than concentrating in single categories. This approach ensures that modifications to specific provisions don't devastate your entire tax planning structure. Regular annual reviews, preferably before major legislative sessions, position you to capitalize on new opportunities while avoiding obsolete strategies that could trigger unexpected liabilities. Part 2. Using technology to track and save taxes. When financial planner Rachel Cruz analyzed her clients' tax preparation habits, she discovered a startling pattern. Those using digital tools saved an average of 23% more than traditional paper filers, not through aggressive strategies, but by simply catching deductions they previously missed. The transformation happens because technology eliminates the human tendency to forget. Consider Mark Cuban, who famously tracks every business expense through multiple apps, claiming this habit alone saves him thousands annually. The principle applies equally to everyday taxpayers who struggle to remember that coffee meeting in March or the home office supplies purchased 6 months ago. Modern expense tracking apps like Mint, YNAB, or specialized tax tools automatically categorize purchases as you make them. This real-time capture prevents the common year-end scramble where taxpayers frantically dig through receipts, inevitably missing legitimate deductions. A small business owner in Mumbai recently shared how switching to automated tracking revealed 45,000 rupees in previously overlooked business expenses, transforming her tax situation entirely. The compounding effect becomes clear when examining investment record keeping. Manual tracking often leads to errors in calculating capital gains, especially with systematic investment plans where multiple purchase dates create complex calculations. Digital platforms maintain precise records, ensuring accurate computation of holding periods and purchase prices. This precision can mean the difference between short-term and long-term capital gains treatment, potentially saving thousands. Filing reminders represent another powerful feature often overlooked. The penalty for missing advanced tax deadlines can be substantial, yet many taxpayers simply forget these quarterly requirements. Automated systems send timely alerts, preventing costly oversights. One chartered accountant reported that clients using reminder systems reduced penalty payments by 85% compared to those relying on memory alone. Deduction calculators built into modern software help identify opportunities that manual preparation might miss. These tools cross-reference income sources with eligible deductions, highlighting potential savings. For instance, they might flag that your charitable donations qualify for additional benefits under Section 80G, or remind you about education loan interest deductions you forgot to claim. Cloud-based storage solves the perennial problem of lost documents. When the tax department requests verification, having organized digital records accessible from anywhere eliminates stress and potential complications. This organization also streamlines annual preparation, reducing both time and professional fees. The key lies in choosing tools that match your complexity level. Simple tracking apps suit salary earners, while comprehensive software benefits business owners or those with multiple income sources. Starting with basic automation and gradually incorporating advanced features prevents overwhelm while building sustainable habits. Integration across platforms amplifies benefits. When your banking app connects to your tax software, transactions flow seamlessly, creating comprehensive records without manual intervention. This automation doesn't just save time, it creates accuracy levels impossible to achieve manually, turning technology from a convenience into a genuine tax-saving strategy. Part 3. The Year-End Checklist. Closing your books like a pro. When December's final weeks approach, even seasoned taxpayers feel the familiar rush of panic. Research by the Chartered Institute of Management Accountants shows that 70% of individuals and businesses leave their most impactful tax-saving decisions until the last 30 days of the financial year, resulting in missed opportunities worth thousands in potential savings. The difference between tax-smart individuals and those who overpay lies in systematic year-end preparation. Consider the case of Ravi Sharma, a Mumbai-based consultant who reduced his tax liability by 1.2 lakh simply by implementing a structured closing routine. His transformation from last-minute scrambler to methodical planner offers valuable lessons for anyone serious about legitimate tax optimization. Your investment pipeline deserves immediate attention. Section 80C allows 1.5 lakh in deductions, yet Income Tax Department data reveals that 40% of eligible taxpayers fail to maximize this limit. Before March 31st, evaluate your current contributions to PPF, ELSS mutual funds, life insurance premiums, and housing loan principal payments. If you've contributed 1.2 lakh so far, that remaining 30,000 rupees invested in ELSS funds can generate both tax savings and potential market returns. Outstanding business expenses create another gold mine. Dr. Amit Kumar Gupta's research on technical tax planning reveals that small business owners routinely overlook legitimate deductions simply because bills remain unpaid. That pending payment to your web designer, outstanding software subscriptions, or delayed equipment purchases all qualify for current year deductions if settled before the deadline. Document organization transforms from mundane task to strategic advantage when viewed through a tax lens. Create digital folders for medical bills, Section 80D, donation receipts, Section 80G, and educational expenses, Section 80E. The Bangalore-based CA firm Ernst & Young documented cases where clients recovered average additional deductions of 45,000 rupees simply by properly organizing and claiming previously overlooked eligible expenses. Salary structure planning offers final hour flexibility that most employees ignore. If your employer permits, convert portions of basic salary into allowances like meal vouchers, transport allowance, or medical reimbursements. These restructuring moves, when done before the payroll cutoff, can shift your effective tax rate significantly. Professional consultation becomes invaluable during these closing weeks. Tax advisor Vinod Singhania's practice data shows that clients who engage professionals for year-end reviews identify average savings of 67,000 rupees compared to self-filers. The consultation fee pays for itself multiple times over through discovered opportunities. Your banking relationships also matter. Ensure all investment proofs reach your employer's payroll department before their deadline. typically falling in early March. Late submissions force you into the refund process, delaying access to your own money by months. Finally, prepare next year while closing this one. Open that additional PPF account for your spouse, research new investment options, and calendar monthly contribution reminders. Tax planning works best as a year-round discipline, not a March marathon. Part 4. Planning for the future. Strategies that grow with you. When Rakesh Sharma changed jobs in 2019, he focused solely on his immediate tax savings. 4 years later, his financial landscape had transformed completely. Marriage, a home purchase, and 2 promotions later, his original tax strategy felt like wearing clothes from college. The strategies that once saved him 45,000 rupees annually now left 1.2 lakhs on the table because he never evolved his approach. Effective tax planning resembles tending a garden rather than buying furniture. Your financial life grows, changes seasons, and requires different care throughout the year. What works for a 25-year-old single professional becomes inadequate for a 35-year-old married homeowner with aging parents and growing income. The most successful taxpayers treat their strategies like living documents. They schedule annual reviews every January, examining not just what happened last year, but what changes lie ahead. Marriage triggers joint filing considerations and spouse-specific investments. Home purchases activate different sections of the Income Tax Act, particularly Section 24 for interest deductions and Section 80C optimization through principal repayments. Consider how life events reshape your tax landscape. When software engineer Priya Nair got married, her tax consultant recommended opening a separate PPF account for her spouse, instantly doubling their 1.5 lakh annual deduction capacity. When her first child arrived, she discovered Section 80D medical insurance benefits for family coverage and child care expense tracking under professional development costs. Career advancement demands strategy evolution too. A promotion from 8 lakhs to 15 lakhs annually shifts you into higher tax brackets, making NPS contributions under Section 80CCD1B significantly more valuable. Freelance income alongside salary work requires different documentation and quarterly payment planning. Technology amplifies your planning capabilities exponentially. Modern tax software learns your patterns and suggests optimizations based on life stage changes. Apps track expenses automatically, ensuring you never miss legitimate deductions like work-from-home costs or professional development expenses. Geographic changes matter enormously. Moving from Bangalore to Mumbai affects HRA calculations dramatically. International assignments trigger different provisions entirely, requiring advanced planning for foreign income treatment and tax treaty benefits. The key lies in anticipating rather than reacting. Create a 5-year tax roadmap that accounts for expected life changes. Plan major purchases around financial year-end to maximize immediate benefits. Structure investments to mature strategically, balancing current deductions with future tax implications. Professional guidance becomes more valuable as complexity increases. Annual consultations with qualified tax advisors cost 15,000 rupees to 25,000 rupees, but typically save multiples of that amount through discovered opportunities and avoided mistakes. Your tax strategy should breathe with your life, expanding and contracting as circumstances demand. The taxpayers who consistently save the most treat planning as an ongoing conversation with their future selves, always asking what changes await and how today's decisions position them for tomorrow's opportunities. Chapter 5. Tales of Real-Life Tax Wins. Part 1. Success Stories. How Smart Savers Beat the System. When Maria Rodriguez restructured her consulting business in 2019, she transformed a $85,000 annual tax bill into just $31,000, using nothing more than legitimate business expense optimization and strategic salary allocation. Her story proves that with the right knowledge and careful planning, even ordinary taxpayers can achieve extraordinary results without crossing any legal boundaries. The power of strategic restructuring became evident when Rodriguez converted her sole proprietorship into an S corporation. Instead of taking her entire $180,000 income as self-employment earnings, she paid herself a reasonable salary of $65,000 and took the remaining $115,000 as distributions. This single change eliminated $16,215 in self-employment taxes annually. The IRS requires S-Corp owners to pay themselves reasonable compensation, but everything above that threshold avoids the 15.3% self-employment tax burden. David Chen, a software developer from Austin, discovered the remarkable impact of maximizing his retirement contributions. In 2021, he contributed the maximum $19,500 to his 401k, added $6,000 to his traditional IRA, and established a backdoor Roth conversion strategy. These moves reduced his taxable income from $125,000 to $99,500, dropping him into a lower tax bracket and saving $4,200 in federal taxes alone. Chen's approach demonstrates how retirement planning serves dual purposes, building wealth while reducing current tax obligations. The real estate investor Sarah Thompson found her goldmine in depreciation strategies. When she purchased a $400,000 rental property in 2020, her accountant conducted a cost segregation study that identified $180,000 in personal property and land improvements eligible for accelerated depreciation. Instead of depreciating the entire building over 27.5 years, she depreciated carpets, appliances, and fixtures over 5 to 7 years. This strategy generated $24,000 in additional depreciation during the first year, saving her $8,400 in taxes. Small business owner James Park transformed his home office into a legitimate business expense center. He measured his dedicated workspace at 280 square feet within his 2,100 square foot home, claiming 13.3% of his home expenses as business deductions. This included portions of his mortgage interest, property taxes, utilities, and maintenance costs, totaling $4,800 in annual deductions. Park maintained meticulous records and used the space exclusively for business, ensuring full compliance with IRS home office requirements. The key insight connecting all these success stories lies in their systematic approach to documentation and planning. Each individual maintained detailed records, consulted with qualified professionals, and implemented strategies well before tax deadlines. They understood that effective tax planning requires year-round attention, not last-minute scrambling. What makes these cases particularly compelling is their reproducibility. None of these taxpayers possessed unique circumstances or insider knowledge. They simply applied existing tax divisions methodically and maintained proper documentation. Rodriguez kept detailed business expense logs. Chen automated his retirement contributions. Thompson photographed and documented all property improvements, and Park measured and photographed his home office setup. These real-world examples demonstrate that significant tax savings emerge from consistent application of established principles rather than complex schemes or aggressive interpretations of tax law. Part 2: Common Mistakes and How to Dodge Them. Tom's mistake cost him $3,200 and 3 sleepless nights. The freelance graphic designer had mixed his personal coffee purchases with legitimate business meals, triggering an IRS audit that questioned his entire expense structure. His downfall wasn't intentional fraud, but sloppy record-keeping that made simple deductions appear suspicious. Most taxpayers stumble over surprisingly basic errors that transform potential savings into costly problems. The difference between smart tax planning and expensive mistakes often comes down to understanding common pitfalls before they happen. Missing deadlines ranks as the most expensive oversight. Sarah Chen, a small business owner, forgot to make her quarterly estimated tax payment by the January deadline. The penalty alone cost her $850, wiping out months of careful tax planning. The IRS doesn't negotiate on timing. Their computers automatically generate penalties regardless of your intentions or circumstances. Documentation disasters create the second major trap. Michael Rodriguez claimed $8,000 in home office deductions, but couldn't produce measurements, photographs, or utility bills during his audit. The IRS disallowed the entire deduction, adding penalties and interest. His mistake wasn't claiming the deduction, but failing to maintain the paper trail that proves legitimacy. Personal and business expense mixing creates particularly dangerous situations. Jennifer Park used her business credit card for personal groceries 3 times, representing just $127 out of $15,000 in annual business expenses. The IRS flagged these transactions and scrutinized her entire expense structure, ultimately disallowing $4,200 in legitimate deductions because they questioned her record-keeping practices. Retirement contribution timing trips up even sophisticated taxpayers. Attorney David Thompson made his IRA contribution on April 20th, believing he had until the tax filing deadline. However, he filed an extension and didn't realize contributions must occur by the original April 15th deadline, not the extended filing date. This $6,000 mistake reduced his retirement savings and increased his tax liability. Overlooked deductions represent missed opportunities rather than penalties, but the cumulative effect matters significantly. Real estate investor Lisa Martinez failed to depreciate rental property improvements for 3 years, losing $9,400 in legitimate deductions. The IRS won't voluntarily point out missed deductions during audits. Prevention requires systematic approaches rather than hoping for the best. Set calendar reminders for all tax deadlines 3 weeks in advance. Separate business and personal expenses completely using dedicated accounts and credit cards. Document everything contemporaneously rather than reconstructing records later. Maintain digital copies of all supporting documents, organized by tax year and category. Take photographs of receipts immediately, as thermal paper fades over time. For home office deductions, measure spaces precisely and photograph the setup annually. The most successful taxpayers treat documentation like insurance premiums. They invest time up front to avoid much larger costs later. Their approach transforms tax planning from reactive scrambling into proactive protection. Part 3. Learning from legal challenges. Staying prepared. When Sarah Martinez received an IRS audit notice in 2019, her first instinct was panic. The small business owner had claimed aggressive home office deductions and business meal expenses that caught the agency's attention. What happened next offers valuable lessons for anyone serious about tax planning. Sarah's case began when she claimed 40% of her home as business space while working primarily from a spare bedroom. The IRS questioned this calculation, along with her practice of deducting family dinners as business meals when she discussed work with her spouse. Initially, Sarah couldn't produce adequate documentation to support these claims. The audit process revealed 3 critical gaps in her approach. First, she lacked contemporaneous records showing the business purpose of each deduction. Second, her home office measurement was estimated rather than precisely calculated. Third, she had mixed personal and business activities without clear separation in her documentation. Rather than fight the audit, Sarah chose transparency and cooperation. She provided all available records, acknowledged the areas where documentation was insufficient, and worked with a tax professional to address the IRS concerns. This approach proved wise when the auditor appreciated her honesty and willingness to correct mistakes. The outcome was better than expected. Sarah paid back taxes and penalties on the disallowed deductions, but avoided the fraud charges that could have resulted from a more confrontational approach. More importantly, she learned systems that prevented future problems. Consider the contrasting experience of David Chen, a consultant who faced scrutiny over his travel deductions in 2020. Unlike Sarah, David had maintained meticulous records from day one. He photographed receipts immediately, logged the business purpose of each trip, and maintained separate credit cards for business expenses. When audited, David provided a comprehensive file that satisfied the IRS within weeks rather than months. The difference between these cases highlights preparation versus panic. David's proactive documentation system made the audit a minor inconvenience rather than a financial crisis. His approach included photographing hotel receipts before checkout, maintaining a travel log with client meetings documented, and saving email confirmations that proved business purpose. Both cases demonstrate that audits aren't necessarily adversarial. The IRS typically focuses on whether claimed deductions are legitimate and properly documented. Taxpayers who maintain transparent records and respond cooperatively often receive fair treatment. The key lessons from these experiences extend beyond documentation. Building relationships with qualified tax professionals before problems arise provides valuable guidance during challenging situations. Regular compliance reviews help identify potential red flags before they attract attention. Most importantly, treating tax planning as a long-term strategy rather than annual scramble creates sustainable protection. These real situations show that legal challenges become manageable when approached with preparation, honesty, and professional support. The goal isn't avoiding all scrutiny, but handling it confidently when it occurs. Part 4. Your Personalized Tax Game Plan. Start today. Creating your personalized tax game plan doesn't require waiting until December or hiring expensive consultants. Research from the National Association of Tax Professionals shows that taxpayers who develop systematic approaches save an average of 23% more than those who rely on last-minute strategies. The difference between successful tax planners and everyone else isn't access to secret techniques. It's following a structured process that turns knowledge into consistent action. Start by conducting a comprehensive income assessment. Document every revenue stream, from salary and freelance work to investment returns and rental income. When software engineer Sarah Chen mapped her 5 income sources in 2023, she discovered her consulting fees fell into a higher bracket than expected. This single insight led her to restructure payments across tax years, saving $3,200 annually. Your income pattern determines which strategies will deliver maximum impact. Next, create a deduction inventory using actual receipts and documentation. Business owners often miss significant opportunities because they fail to track eligible expenses systematically. Restaurant owner Marcus Rivera started photographing every business meal receipt and logging mileage immediately after trips. His meticulous tracking revealed $8,000 in previously overlooked deductions. The key is establishing capture systems that require minimal effort but ensure nothing falls through cracks. Investment goal alignment forms the third pillar of effective tax planning. Rather than choosing investments based solely on returns, successful planners evaluate tax implications first. When tech executive Jennifer Walsh shifted her 401k contributions from traditional to Roth during a lower income sabbatical year, she saved approximately $15,000 in lifetime taxes. The timing of investment decisions often matters more than the investments themselves. Progress tracking transforms good intentions into measurable results. Accountant David Kim recommends quarterly reviews rather than annual assessments. His clients who implement quarterly check-ins achieve their tax-saving targets 78% more often than those conducting yearly evaluations. Regular monitoring allows course corrections before mistakes become costly. Technology can streamline your entire process. Apps like Shoeboxed automatically categorize expense photos, while software such as TurboTax provides year-round planning tools. However, the most sophisticated system fails without consistent execution. Begin this week by selecting one action from each category. Map your income sources, photograph 5 business receipts, research 1 investment option, and schedule quarterly review dates. Small, consistent actions compound into significant savings over time. Remember that tax planning operates within legal boundaries that benefit compliant taxpayers. The strategies outlined throughout this book provide legitimate pathways to reduce your burden while supporting economic growth through increased investment and spending. Your personalized plan should reflect both your financial goals and ethical commitment to responsible citizenship. The knowledge you've gained means nothing without implementation. Start today with one simple step, then build momentum through consistent daily actions that transform tax season from stressful scramble into strategic opportunity.